you have to listen for what's not being said. So is somebody really happy? Do they seem like they're truly in this for the long run? Or are they just going through the motions and you can tell that they're frustrated underneath the surface, or they don't agree, but they can't say that? And so it's really a lot of reading people and feeling the energy in the room. And if something feels off as an investor, you have to follow your gut on that.
Hi, everyone. Welcome back to the PlayBridge podcast. Today, I am joined by Gale Wilkinson. She is the founder and GP of Vitalize VC, an early stage fund and angel community investing into Worktech software. She's investing at the pre-seed and seed stage. Portfolio companies include Placer, The Mom Project, Workmade, and more. Gale, so excited to meet you and to have you on the show. So welcome.
Thanks for having me.
Of course. So to start it off, I'd love to just go back to the original founding of Vitalize VC. How and why did you first launch the fund and the angel community?
Sure. I've been in VC for just over a decade. My first group that I founded was called Irish Angels, which was an angel syndicate affiliated with Notre Dame. And in 2017 started Vitalize, which was a separate fund that invests in early stage B2B software. So we had done some good deals historically, and a few of my investors came to me and said, hey, I missed those deals, but would love to buy a basket of your stuff. And so I formed a fund at that point in time. So Fund 1 was a $16 million vehicle, and I deployed that from 2018 to 2021. And now we're investing out of a $23 million vehicle.
So from what I saw, you guys invest 50 to 150K at the pre-seed and 250 to 750 at the seed stage into Worktech specifically. So I'd love to understand and unpack a little bit more of your investment thesis and your strategy there.
Yes, over time, I've realized that it's important to be really specific about what you invest in. And so we moved from generalist B2B software to Worktech from Fund 1 to 2. And we define Worktech as any B2B software that dramatically improves work outcomes. So that is largely enterprise software. We do mostly horizontal, a little bit of vertical. And then we also look at the infrastructure for the freelance economy, which we believe is going to continue to get very big. And then finally, a little bit of HR tech, which includes learning and development, hiring, and employee engagement and retention. So that's our definition. And we do out of our fund rate checks that are 250 to 750K at the seed stage. And then anything that's earlier stage, which we would consider pre-seed, we can look at those smaller checks out of our angel group.
What's an example of a company you've invested in recently to just give people a better vision of kind of what you look for in deals?
Our latest fund deal is one called Lead Sales. So this is a founder who's based out of Mexico City. It is a US-based company, but they're selling into LATAM, and it's a way to rethink how work is being done from a customer support perspective on text. In a lot of other countries, text is really important for servicing, whether it's on social media or SMS or any other text apps. And they have an amazing interface that allows companies to pay for their solution that then they can communicate with their customers a little bit more seamlessly than before. So that is Worktech because it rethinks that customer contact piece. One that we just did out of our angel group is called Lucia, and that is it's in the Worktech space because they are a marketplace for hiring help in the travel vertical. The travel vertical is huge. So hospitality requires all kinds of help, many of whom are contractors. And Lucia's solution is great for not just finding help, but getting streamlined operational assistance as well.
Interesting. My friend is actually a travel consultant with Fora. I don't know if you followed that company, but really interesting things going on in that space.
Yeah, it's a huge industry.
Yeah. Yes. Yeah. I'm curious. So before launching the fund, you were obviously running the angel group, and that's like really how you got started investing. Would love to just understand more about why you launched the Irish Angels originally and how you like built that from the ground up. Would love to hear more on that story.
Yeah, that's a random way that I got into that. To be honest, I met some of the early board members, and it was actually before they started that version of Irish Angels. And I was looking for an entrepreneurial opportunity when I finished grad school from Booth in 2012. And some of the board members said, hey, we've wanted to do this for a long time. We think there should be an angel group affiliated with Notre Dame, but we don't know how to do it. We can't help you. We have no money to pay you. Are you interested? And I had gotten a scholarship from an organization called C200 at the very end of business school. So I had 3 months of living expenses. And I said, if we can find 40 people to join within 3 months, then we'll figure it out. So it took about the 3 months and we found the 40 people. And then I just got my credit card out and started it and figured everything out. So made lots of mistakes and luckily did some things right. So it just kind of evolved over time into the investment journey that I've had.
What were some of those mistakes, if you're willing to share, and maybe some of the biggest wins you had when you were first kind of diving into investing?
So many mistakes. I think the biggest mistake that I made was I didn't realize how much of a people business it was right away. And, before business school, I'd started 2 companies. And I guess one was before, one was during. I am more of a founder. And so I'm a huge optimist. And if you tell me something, I'm going to believe you at face value, or at least I did when I was 29 and I was starting Irish Angels. And so if a founder would be like, here's what I'm going to do, and here's what I've done, and here's all these things that I can tell you about my business, I would just believe it at face value. And today I know that I have to listen for clues to understand if they're telling me something that's accurate or not. And it's not necessarily that they all mean to stretch the truth, but I think a lot of times we as investors want to believe what the founders are saying, but we have to really figure out how to assess what really can happen with these companies. And I've gotten much better at that over time. So that's probably my biggest mistake. The other mistakes that I've made are just around picking founders, other things. So if a founder is pushy and says, hey, our round's closing really fast, you have to get in. I used to be like, okay, what do I need to do? And I would jump through any hoop. If a founder told me that today, I'd say, see ya, good luck. I'm not interested, because there is a 1-to-1 correlation with founders who are very pushy or not willing to give information during the diligence process, or are disorganized, or there's something else negative that comes up during the diligence process. Truly a 1-to-1 correlation with their success, and at least in my portfolio. So whenever I have looked to the side and ignored something that was not great, those deals have never done anything for me. So I have to pay attention to that stuff. And on the flip side, and the positive, when I first started, I think what I did do a great job was build a network. And, your deal flow is everything in this business. And my it was third and fourth check are probably going to be 2 of the biggest winners of my career.
Wow.
And so there's obviously a little bit of luck in there, but
That's so cool.
you have to go out and actually build a network and make it happen for these things to have a possibility. So when I talk to people wanting to get into VC now, it's all about what specific network do you have that you can build and then add value to that network. And then that network will add value to what you want to do.
How did you think about building your network? Was it really within that like Notre Dame ecosystem, or how did you kind of evolve it from there?
For me, it was a couple of different pieces. So it was the Notre Dame alumni. It was folks in Chicago. So when I was first starting out, I would just literally go to every event. And I tell people to do this now when you're first starting out in something, go to all of the events. Obviously, over time, you'll figure out what you like and what you don't like, or what's helpful, what's not helpful, and you can tweak it. But I built that out. And then I also built out a network of peer investors. So these would be others running angel syndicates or others running small funds. And so I have pockets of network from that perspective all over the place, like probably close to 1,000 at this point of folks who I've done work with or that I know very well, which has really, it's taken a long time to build, but it's very valuable, and a lot of friends in that network now.
But venture is like a long game, so it makes sense that these relationships as well take a long time to build. Can you share what your third and fourth investments were, and the ones that you think will be some of your biggest wins as an investor?
I can share. So those were done via Irish Angels. I'll share my top performer out of Fund 1. It's a company called Placer.ai. So those first 2 are unicorns. Placer's also a unicorn. It's effectively foot traffic data. And the company has done an amazing job of accelerating revenue and providing true value from a data perspective to all kinds of customers. It's another lesson learned. There is true value in proprietary data. In fact, I've always been a little bit more interested in data than in AI, and I still am. I was on a podcast recently who was asking me about AI. And I do think AI is important, and I think it's table stakes, which means everybody needs to think about it to some extent. But really, that value lies in the proprietary data sets, which I'm seeing with Placer for sure.
What are like the types of data that Placer pulls together? And then I'd be curious, when did you invest in them? Like what stage, and anything that you remember that stands out from like meeting the team or their pitch at the time?
Invested in 2018 in their seed round. And it's interesting because I'm not, as a generalist B2B investor, I was not a prop tech investor. And I remember sending it to a bunch of my prop tech friends, all of whom said, hey, no, this is not going to work. So there is some, I think, magic in not being too close to a deal, which is important for all of us to remember who have industry specialties. But I loved the founding team because the CEO was a technical gentleman, product background, technical background. And then the head of biz dev had grown sales from 0 to 100 million for another startup. And he told me, I want to do it this time and I want to have that ownership. And that kind of experience is really valuable because they've proven that they have done it. And for somebody that stuck through a business that long, like they definitely have the ability to do that again, and they want to reap the economic benefits from it. So there's real economic incentive for that team to want to dive in. And I just loved the team. They were two fantastic gentlemen. And I also liked a lot of the other investors involved. So I make a lot of my decisions based on, is it a big market? What are the data angles and all the people involved, the team, the board, the other investors?
With the other unicorns in your portfolio, do you see like other common themes?
So some things to look for that I learned in those deals. And not just those deals, because I'll be honest, some of my best performing deals, not Placer, but some of the other ones, I really didn't know that they would succeed. In fact, I kind of wrote both of them off in my head before they went anywhere. So that's something to remember, that a deal that looks like it's doing really well may end up crashing, or a deal that's doing really not well or seems to not be doing well could be an amazing deal. And as a small check writer, sometimes you just really don't know. So a learning that I have had over time is that any early stage business that I see where the revenue is growing quite quickly and it's up and to the right, I want to probably do that deal. Now, I do think there's kind of a potential for a no person's land between 1 and 2 million. So if you grow really fast to 1.5 million, sometimes there's a flat line. And that can happen because those early adopters, it's not real product market fit. They're just excited to try stuff. And or that founder has a network where people are doing them a solid. So if I see that the company is growing really quickly, I have to make an assessment by going out and talking to other prospective customers. Is this a real pain point in the industry? And is this solution something that they're going to buy? And if that lines up with that strong growth, I almost will always do those deals. And that almost has a one-to-one correlation with good success.
Will you walk us kind of through your typical due diligence process and maybe how that's changed over time?
It's changed a lot over time. I didn't know at all what I was doing up front, but due diligence, for those that are not in a professional investor, it really just means analysis. So it's going out and doing research and analysis on potential investments. And you can do diligence on any type of investment, but particularly for VC, what we want to do is understand what is built today, what is the target market, how big is that market size, what traction is there in terms of revenue and growth, what is the team's background, do they have startup experience, do they have experience in this industry, why are they passionate about it, do we think that they're going to stick with it, and what potential outcome are they looking for. So some founders are looking for a quick flip. That's more of an angel potential deal versus a VC potential deal. We're really looking from a VC perspective for those that can at least 30x our value today. So I do all the math on that. Yes. to kind of figure out, is there a potential for 30x?
What do you think is the potential angel exit that you're looking for in comparison to the 30x for VC?
Well, I tell people who are angel investors that it really depends on what you're looking for. Some people will say 5x, some would say 10, some would say 30, some would say more. For me personally, it's probably a 10x return that I try to underwrite to. And success in angel investing is the same as VC. An angel is really trying to 3x plus their money over time. And a VC needs to at least 3x plus their money to be in the top 25%. And a 5x net return to the limited partners, if a VC returns that, they're in the top 10%. So, I mean, it really is hard to be a high performing fund manager. And that means on the angel side, since people are investing their own money, there's a little bit more wiggle room. And some angels feel very successful if they only 2x, for example.
Back to the diligence process. Is there anything in your diligence process that you do that you're like, I must always do this during diligence, like something that you find very critical to that piece of the process?
Yeah, customer references and team references. So we talk with, we obviously talk with the founder, we talk with their key team members, we talk with any board members, any current investors, any former investors. We talk with a few customers. And oftentimes we, as one investor among many, will share those notes. So it's not like every investor has to do that. In fact, we try and make it easier for the founder that way. But the reference calls tend to be the most important because we're seeing some background info and true insights on not just the team, but also from customers that haven't even seen it. What do they think about it? And that helps us to assess that pain point. And is there really product market fit here?
Before we go too deep into the investing landscape, would love to also go back to the beginning of your career. You mentioned earlier that you started 2 companies before diving into investing, and then you also did your MBA. So would be curious to hear, one, what were those 2 companies you started, and then why and how did you end up pursuing your MBA?
The first one was called What College Forgot, and it was about all the things that we don't learn in college that we need to know to succeed in the real world. So it was effectively a site about managing your money and career development and getting your apartment or buying your first house or whatever, stocking your first kitchen. So I worked on that on nights and weekends while I was working at Orbitz. And it was a lot of fun just to kind of figure out, how do I go and find somebody on the dev side to help me build this? And how do I, get it off the ground? And it got to a point where there were several 100,000 visitors per month, but I never figured out how to make money. And in hindsight, the big lesson that I take from that business is twofold. One, build it with your revenue model in mind, and 2, don't start out too broad. And this is definitely a problem that many founders have, where they're like, oh, I want to do everything under the sun. I'm working with 2 women right now starting an amazing business, and I've had to really be like, what exactly are you trying to do? And stop thinking about the other stuff. You may do it at some point, but today we have to tell the story of just this one thing. And then the second business I started was called Hire Bright, and it helped startups and growth companies to hire students and recent alums. And that one I do think ended up selling, but I had some co-founder differences. So unfortunately, I did not agree with my co-founder, and that's another lesson that I've taken. So co-founder blowups and disagreements are one of the biggest problems that startups have. And I always want to understand that dynamic. In fact, I have passed on deals where there are co-founder problems.
Yeah. How do you suss that out in diligence? Any advice?
If I'm in person, I like to meet with them face to face. And then I see how they interact with each other and how they talk about each other. And if they are really valuing each other's opinions or one person talking over the other one, that's truly a telltale sign. There's an angel investor who likes to have them introduce each other to see how they talk about each other. So that's another way you can do it. But this is one of those things that I was telling you that I had a big learning about over time. You have to listen for what's not being said. So is somebody really happy? Do they seem like they're truly in this for the long run? Or are they just going through the motions and you can tell that they're frustrated underneath the surface, or they don't agree, but they can't say that? And so it's really a lot of reading people and feeling the energy in the room. And if something feels off as an investor, you have to follow your gut on that.
Other than like co-founder dilemmas, what are some other common reasons you've seen startups fail?
Yeah, no revenue model is a big one. Market size is not big enough. And that only means you shouldn't go after VC. If your market size is small or niche, you can still have a great business, but those folks should not be raising venture, or they're not looking to grow revenues very fast. Can be a great business, not venture. This is related to co-founder issues, but cap table problems where they've given away too much equity to advisors or to early investors or to former founders or founders that are likely to leave. Any of those things leave what's called dead equity on the cap table. And as an investor, I don't want to see more than about 5% of that at the early stage. If there's more than 5%, oftentimes I tell founders just to give up and close the business down and start another one and learn from that mistake.
Any resources you would point people to like understand how they should be managing their cap tables and like how they should be splitting and sharing equity?
Ideally, there's one. The answer is no, I can't think of anything off the top of my head. But what I would tell people is ideally there's one primary founder who owns the majority, and make sure everybody vests over 4 years with a 1-year cliff so that, if you and I started a business and I'm not pulling my weight, you can be like, hey, we have this partnership agreement, and you can go like Cooley's got good templates for this. There's a lot of firms out there where you can get templates for little to no money. And if I'm not doing what I said I'm doing, the documents dictate how we can unravel that so that you're protected, and vice versa. Something that you did something that I would be protected. That's really best case scenario. And that vesting schedule saves founders from losing too much equity if somebody is not performing. So that's truly the most important thing. But oftentimes folks will start a business and they'll be like, let's go in 50-50. And then one person's way more into it. But then something happens that's kind of good in the business. And the person that's like, oh, well, I'm not going to work on this anymore, but I still want my 50%. They're going to kill the business.
I would hate to see that. That's terrible.
It happens all the time.
So crazy. Yeah, I think Cooley Go has like a lot of great legal templates. So back to your kind of career journey. So you did the startups. Then why did you decide to pursue your MBA?
The MBA was after the first one, What College Forgot. And I decided to do it because I had worked with a bunch of people who went to Booth when I was at Orbitz, and I loved them. Like, they were just great people. So I went to the info session and it felt like a good fit. And then I got in. So I was like, okay, well, this is a good time in my career to do this because I want to pursue entrepreneurship. And so I basically triple concentrated in entrepreneurship and didn't really concentrate in anything else because Booth doesn't have majors. It's all about concentrating. And so I think I only tell you about HireBright, but I had started a few other ones. So, I really went pretty deep into a number of business models while I was there, which was a lot of fun. And I learned a lot. And I knew coming out that I didn't want to do anything other than something entrepreneurial. So I had a few interesting offers, one of which was to start Irish Angels. So it set me on the path to working for myself.
I also went to UCLA for my MBA, also because I wanted to start businesses and was like very entrepreneurial. I always get questions from people like, is the MBA the right place for a founder? What is your opinion on that? It sounds like you had a pretty good experience.
So I get asked all the time for my opinions on things. And I like to say, this is one person's opinion. And here's the real answer for pretty much every question is, what feels right to you? And so if you think about going to an MBA and it turns your stomach, and I don't want to spend the money, or I don't want to do this, or if it doesn't feel right, don't do it. If it sounds exciting and you go to the info session and you meet people, you talk to people and you're like, oh my God, I love the idea of traveling and I love the idea of whatever about it, then do it. Like for me, I would not give up the network that I built for anything. Like some of my best friends I met at Chicago Booth. And so I'm like, okay, let's just be grateful, even though it cost a ton of money. It ended up paying off because of that network. But for me, it was also like a finishing school. I don't come from a lot of money. I had no idea what finance, anything was, consulting, iBanking, private equity, venture capital. I didn't know what any of it was. And just to have ended up where I have is weird. based on how I grew up, but I wouldn't have known anything unless I went to business school. So there's a lot of magic that can happen when you do something that might seem like there's not a clear path for it.
I'm about 2 years out from business school, and I'm starting to see kind of the power of building that network from school, which is cool. And I'm sure in 10 years, it will be even more powerful. Would love to hear a bit more about Vitalize Angels. Curious about like who can get involved investing with you in your community and kind of like how it works for angel investors that are investing with you.
Yes, Vitalize Angels is a group of about 540 people today. So we've got both accredited and non-accredited people. And what that means is truly anybody in the world, as long as you're 18 years or older, can be a member of our group. And we did that intentionally because we want to bring more people to the table. After investing in this industry for over a decade, I have seen firsthand how hard it is for people that look different to even be asked to write a check, to be included in the conversation, to be given a chance. And so we want to make it safe for people to sit in the room, hear pitches, see our diligence, learn, network, all that kind of stuff in a way that is inexpensive and provides them with the opportunity to get at bats writing as low as $1,000 checks. And we, in order to do this, partner with WeFunder. So it is crowdfunding, but that allows us to have the accredited and non-accredited invest together. And as long as we get $50,000 as a group, we will do that deal. We've done 17 deals to date.
That's amazing. I'm curious, who do you think like should be investing in this asset class? Because I think that's something like I grapple with a lot of like non-accredited versus accredited investors and like what level income or education do you think? Because it is a very risky asset. Like, what is your opinion on that?
Anybody that makes over $200,000 a year should at least consider it strongly. Anybody who makes over 100,000, can consider it if they want to. Even anybody that makes less than that depends on their circumstance. They may not. And this is, once again, my opinion. These are not like rules of thumb by any means. But at the end of the day, the guidance is invest no more than 10% of your investable assets into this class. I invest way more than 10%, and I'm happy that I do. But that's maybe not for everybody, which is why I kind of suggest to people, all right, figure out your income, figure out your expenses and your taxes, and how much do you have left? So that is your investable cash. And let's say it's $20,000 a year. Well, maybe you want to take the 10%. So you want to do 2,000. In our group, you could do two $1,000 checks. Or you might say, okay, I already have my 6-month set of cash in the bank and I feel very safe because I've got my net there. Maybe I want to do 5,000 of the 20,000 or 10,000 of the 20,000. That's totally fine if you wanted to do that amount. But the important thing is that you have that number at the beginning of the year. So for me, my number right now is probably, let's say 15,000. Okay. So in any given year it might be different. And that's something to do the math all the time. Okay. So if I'm 15,000, I do about, let's say 12 deals a year because I invest in every single Vitalize Angels deals. So I know that every time a Vitalize Angels deal comes through, I put $1,000 into it. And then I typically do one, maybe two other $5,000 investments. Like I just invested in a friend's company who has a ton of revenue and she let a bunch of women invest. Like these are the types of things that I look for because the access is there. We just have to listen for it and then take advantage of it when it comes up.
Okay, so with these smaller checks, like should I be investing at like the pre-seed stage, or do you think like at the seed stage it's still like my check will go far enough?
Do you feel comfortable telling me what your strategy is?
I'm definitely still working on my strategy, but I can tell you some of the investments I've made so far. So far it was into 3 seed extension deals, a company called August, a company called Upkeep, and a company called Alinea Invest. Upkeep is ClassPass for booking med spas. Alinea Invest is a fintech app for investing for Gen Z investors.
Awesome. And how did you find the deals?
2 of the 3 met the founders through like the content media I do on TikTok and on my podcast, and basically was able to get allocation with my small checks because of media and promotion I can do with my TikTok.
Love that angle. And you're investing directly into the company, correct?
One was a direct investment, one was through a syndicate.
Is the syndicate an angel group or an RUV?
Angel group.
So I ask all these questions because at the end of the day, any strategy can make sense. And I really believe that the first thing everybody should do is figure out that amount. So get your number. So I know my number is 15. I know when the VA deals come up, I do 1,000 and I can do 1 or 2 $5,000 checks. And I refresh that number every year depending on what I know I will have. Now, you can also do funds. Like I've invested in some small funds before. So I've done a $5,000 check into a fund, a $10,000 check. I've done a couple 25,000s that are called over time. So they're still within my, every year I do 10 to 25 or 50,000 in this asset class. That's kind of my
Definitely
range.
Thought about that as a potential path.
So that's something to consider. But then the next thing is, what is interesting to you? Is it an industry? Is it a geography? Is it a type of founder? Is it doing funds because you want to learn? Like my thinking is actually shifting to where I want to do more funds going forward because I love to see how the other fund managers think. And sure, the upside is limited there, but there's also more diversification. And so it's a little bit less risky. So it's a different strategy, but it can make a ton of sense. So once you know your number and you know what you want to invest in, then it's finding access. So you have great direct access. You can do syndicates. So Angels has a free membership. Vitalize Angels has a free year membership for students, or ours is $600 per year. I know the council is relatively inexpensive to join if you're accredited.
The council is the community I've invested with.
Great. So yeah, there's a ton of them. The Hustle Squad's a little bit more expensive, but it's also good. Anyway, figure out where you feel drawn. And that becomes your strategy. And then from there, it's just spending time on it and it's writing your first check. And that's probably the scariest thing for people is, this sounds fun in theory. I like to listen. I like to learn. I don't really want to get my money involved because that's where I get scared. But remember, you've done the math. You figured out what can you truly light on fire. If I lit this $15,000 on fire right now in front of me, right here, my life would not change at all.
That's definitely been my mentality. Yeah. That's how I carved out my dollar allocation.
That's how you have to think about it. So for you, if that amount feels right and you like the deals that you're doing, I would say that your strategy is correct. Now, the last piece of a diversification strategy for angel investing to remember is ideally you can build a portfolio of at least 15 deals over a couple of years. So most people, if you can do it, should do at least 3, if not at least 5 deals per year as you're building that portfolio.
Yep. But do you think as an angel,
if that's all you can do is fine.
As an angel, do you think you need to be in at the pre-seed, or investing at the seed is still a good place to be playing? And what about Series A? Or is that just too late?
If you have access to deals that you like that are not seed stage or not pre-seed and you can get angel checks, great. I mean, I've done all across the stack in terms of stage. And sometimes you can do great angel deals later. Sometimes you have to do them earlier, but I invest in syndicates alongside people that I know and trust. So I'm in one deal that I think its valuation was like 300 million, which is way more than I typically do in my angel deals. Wow. But it is a new technology to mass produce vegan and non-animal product fabrics, which I care about personally. That's another thing to remember with angel investing is like, you can invest in anything that you care about personally, which is really cool. So to me, that's more important than stage. But somebody else might be like, you know what, stage is all I'm about. And that's great for them.
And then I'm curious, so we're running this amazing angel community. How did you decide to take the leap to actually launch a fund? And what have been like the major differences between just starting with the angel community and then building a fund, which is obviously a whole other endeavor?
I don't know that I could have raised a fund without first doing the angel network because what I was able to do with the angel network is prove to all the people that I was working with that I'm trustworthy. So I take my obligation as a fiduciary to my limited partners and to my angel investors very seriously. And that means that I make sure there are no mistakes with legal, there are no mistakes with money. I make sure that I do everything that I can to not just get into good deals, pick good deals, but also to add value to them and make sure that we are returning capital. Because at the end of the day, if I am not able to deliver at least a 3x return and be in that top 25%, my investors' money is best spent elsewhere and my time is best spent elsewhere. So that's kind of how I think about it, whether I'm working with angels or the fund. And so it was really a natural progression. And I think there's pros and cons to each model. Like the angel group, I truly loved being in front of a group of 150 investors in Chicago every quarter. I mean, I did 39 of them before I left Irish Angels. And it was like running a huge gala every quarter where my favorite people were coming in the room and these amazing founders. And it was so high energy and so fun. That I actually do miss that now because I work primarily from home and I don't have that. But with the fund, you have a little bit more predictability in terms of what you can invest. And so some would argue that you get into better deals. I don't necessarily know if that is true or not. But we now have a little bit of both with our angel group and our fund. I think that combo works really well because our angel group is doing stuff that's a little too early for our fund. And it allows us to watch founders and help them when before we would have said, oh, just come back to us in a year. Well, now we can give them a little bit of money and help them.
And I feel like I imagine like with the council, a lot of the members end up being like not only like deal flow sources for the fund, but also like they're operators oftentimes and can help some of the portfolio companies. I don't know if you've seen some of those synergies, but it's a very smart model. Back to your earlier point of like access to the VC industry, like what do you think are some things you've seen that have worked and that we could be doing to like open up access and get more people investing, whether that's as angels or as, people in VC?
Lots of things. But I mean, honestly, the real answer is that institutional capital needs to rethink their ways. And for those of you who don't know what institutional capital is, these are large pensions and endowments and other big pools of money that could come from corporates or from fund of funds or from family offices. And these big check writers historically have wanted to invest in proven networks. And proven networks mean what has been around historically. And that means white men who went to Harvard and Stanford. And so like I say that and laugh a little bit because it truly is about 44% of the people went to Harvard and Stanford. And so when you think about there's more people that went to Harvard and Stanford than are underrepresented check writers, like that is absolutely insane. And the fact that people aren't questioning that is just bonkers to me. Because and we've seen this in the last 2 years, all these institutions threw money into what they thought were the safe funds, and they were all later stage investors, and they increased the prices. Nobody could sustain those valuations, and the market crashed for VC, and it hasn't come back. And all those LPs are sitting there, these limited partners who put money into what they thought was safe and the best, are underwater on paper. And I don't think this is going to come back by the time that things right size. Like, they're not going to make money on this, but they're still going to invest in these same things because they can't think about, oh, well, maybe I should invest in Gale's fund or a fund that could invest in Gale's fund and the council and a whole bunch of other small VCs because they're actually seeing different stuff and they're thinking differently. No, we want only VCs that invest the same way that has always worked. But you've got this problem where these institutions are looking in the rearview mirror and we VCs are looking forward. And so there's a mismatch. And until that gets fixed, I think that a lot of people are not going to get the capital that they need to truly make a difference. And so what's going to happen is at the early stages, individuals are going to step into that opportunity set and really prop up early investing, which is a great thing. And I think we who are already in the industry have an obligation to effectively ask other people to join us.
Have you seen like any kind of like I've followed what Recast is doing. I'm not sure if you have followed them, but like any other like groups or organizations like that are trying to like kind of shift and change the LP landscape?
Yeah, Recast is a good one. There are some other ones like Plexo Capital, Screen Door, um, BDO 1360. There's Equity Alliance. I mean, Bank of America is one of the largest LPs in emerging managers out there. So there are definitely players that care about this. I would just argue that there are too many small funds to get the institutional dollars. Like for my fund that I just closed, hardly any institutional capital came in. And I think we're going to keep seeing that. So it's really the individuals who are going to be the ones investing in these small funds.
Well, I could ask you so many questions. You've been so informative today. So thank you so much for fielding all of my questions. But as we start to wrap things up, I ask everyone this at the end of my show: is there a female founder, investor, or leader who inspires you? And would love to just hear a little bit about why.
The way that I will answer this is really to highlight, I think, a lot of the peers that I have met over the last decade. I'm just really impressed with what they have achieved. So, Norma and Shane at Supply Chain, or Jenny at the fund Now Everywhere Ventures, or Sarah and Courtney at Recast. And the list goes on and on and on about all of these amazing women that I see out there doing it right now. I think that inspires me more than anything. And I'm very grateful to women who have kind of come before us and done it. And there aren't enough of them, but I know that they really made it a lot easier for us, even though it still seems more challenging than it should be.
I think we're just each generation have to get better and better.
Yeah,
Slow
and
progress.
I would also, one of the things that I am starting to try to figure out is how we invite men into this conversation in a safe way. And I know most of your listeners are probably women, but I would ask all of your listeners to talk to their husbands or their boyfriends or their partners or their brothers or any male in their life about these topics. And I really believe that because I haven't seen change in 10 years, in fact, things have gotten worse in terms of dollars going to underrepresented founders and going to female founders. Unless men get involved in this conversation, there will be no change by the time that your daughters are my age. So I'm 41. By the time they're 41, however old your daughter is today, there will be no change until we get men involved in this conversation to help underrepresented people. Full stop. They've ignored it so far, and I understand why, because I think we've done a bad job as a society of making men feel bad for mistreatment of people. And so as from a position of power, they can just ignore that and say, you know what? I don't like this conversation and I don't have to listen because I don't need to listen. But I think we have to invite them to listen and invite them to be the heroes that save others, specifically women. So men, can you reach down and help women? Can you invite them to the investment table? Can you promote them? Can you give them money? Can you be the one that's the hero rather than someone that's going to ignore it? Because if you continue to ignore, at some point, there's going to be a group of men that say, you know what, this is ridiculous and let's start trying. And I would hope that all of the good men out there are on the side of those who are trying.
Definitely need our advocates to really make serious change. So could not agree more. Amazing. Well, thank you so much for joining the show. The last thing is, where can people find you and where can people find Vitalize VC?
We are at www.vitalize.vc. All sorts of information on the website, both for founders and for angel investors. And then you can follow us on X. My handle is at GaleForceVC. And then we also post on LinkedIn and have 2 newsletters as well, which you can find on our website.
Amazing. Well, thank you so much again. I seriously learned so much from this 45 minutes. I appreciate it.
Yes, thanks for having me. I appreciate it.